Welcome to this IMF-IMFS event policy webinar. We haven't had one in a while, but it's great to be back. And thank you also for joining us on a Friday evening here in Europe. At least in Germany, the sun is shining. It's warm. I don't know how it is in Milan, Elena. We have one guest, Elena Carletti from Milan, and of course from the IMF, Erlend Nier in Washington, D.C., and Francesco Mazzaferro here also from Frankfurt. Erlend, how's the weather in Washington, D.C.?
It's also temptingly nice.
Okay, so good news for financial stability, we hope. At least the weather is good. We've had certainly some stress and some trouble throughout this year since March in the financial sector. And so it's particularly interesting to be looking at this recent research here. I'll show you the paper, Macroprudential Policy Effects, Evidence and Open Questions by a team from the International Monetary Fund, different divisions, monetary and capital markets, research and strategy, policy and review departments. And I won't mention all the authors right now, but we've had previously, it's already a while back, I guess, quite a while back, a similar paper with Gaston Gelos on negative interest rate policy. He's also a co-author here. But today I'm very happy to welcome Erlend Nier from the IMF, who will present the paper, say, during the first 15 minutes or a minute or two more. He's actually the Deputy Division Chief of the Monetary and Capital Markets Department at the International Monetary Fund. He covers monetary and macroprudential policy. They're supposed to achieve stability goals in advanced and emerging economies. And he actually has also previous experience from the Bank of England's Financial Stability Directorate, where he was research manager, and has, of course, published in many international journals, and originally holds a PhD from London School of Economics. Our second speaker and first discussant will be Elena Carletti. Elena, welcome. It's great to have you. You have so many positions now. Amazing. It's been many, many years when you were here in Frankfurt. You're professor of finance. I see you're dean of research at Bocconi, the leading Italian university, one of the leading European centers. It's great to have you. You're also on the executive committee there. You have a new Institute for European Policymaking, directing banking and financial regulation at the BaFi-Kerfin Center for Applied Research. You're at CPR. Interestingly, you're a member of the board of directors of UniCredit Group, but I'm sure where you're chairwoman of the Internal Controls and Risk Committee, you're also a member of the expert group on banking supervision at the European Parliament. I stop here. And many other things I could mention. I hope you can speak freely, but of course you'll be speaking also in your personal capacity. Same goes for Mr. Nier, of course. And finally, our third discussant will be our third speaker. Second discussant will be Francesco Mazzaferro. Francesco, it's great to have you. You're the head of secretariat at the European Systemic Risk Board, the ESRB. You have been doing that since 2011. So you've been involved in designing macroprudential policies, assessing the situation in Europe for quite a while. It's great to have you. You're also originally began your career in Italy at the, Istituto Bancario Sao Paulo di Torino in Turin, Italy. But you've also worked extensively and gained big insights at the European Commission in Brussels. But you've joined already in '95 the European Multi-Institute, etc., etc. So it's great to have you. You also have a PhD and a master from University of Bologna. You have actually legal experience. You're a lawyer, so I have law experience. So it's great to have you and get this mix of European international perspectives. So without further ado, I didn't introduce myself. I should say I'm Volker Wieland, just for those who don't know. I'm a managing director of the Institute of Monetary and Financial Stability. We're delighted to do this together with the IMF. I'll hand over now. This is recorded, right? So I hand over now to Erlend Nier to present the paper or the key insights. You'll probably be sharing some slides. So up to you, on to you, Erlend.
Okay, thank you, Volker, for the introduction. Let me give you a brief overview of the paper we published recently, and that is joined with several IMF colleagues, as you mentioned. Why did we think it was time to prepare the paper? What are the questions we ask and the methods we use? And what are the key findings and conclusions? I should say the views expressed here are mine personally and those of the authors, and should not be attributed to the IMF, its executive board, or its management. The starting point for us is that, and for everyone here, I think, is that macroprudential policy is still relatively new. While emerging market economies were early adopters, many other countries have been gaining experience with the use of the toolkit only since the global financial crisis. New capital and liquidity tools, such as the countercyclical capital buffer, the liquidity coverage ratio, and the net stable funding ratio, were introduced as part of the post-crisis banking reform. Borrower-based tools, such as LTV and DSTI, have also become more widely used since then. After years of tightening, the COVID shock was a first test of countries' readiness to relax tools in stress periods. And rising interest rates now pose a new resilience test for the financial system. So can we tell how well macroprudential policy tools work based on the use made of the tools so far? Let me first show you a chart use of macroprudential policy over time. This shows the net tightening of tools that has occurred since the GFC. These are the bars of growing height that you see in the chart. It also shows how countries did actually relax tools at the onset of the COVID pandemic. At the far right of the chart, you see the bars going down. And that was done in order to support the financial system through the period of stress. Much like actually emerging market economies have been able to relax macroprudential policy tools in the earlier GFC period. And you see this towards the middle of the chart. This also suggests an issue for the empirical analysis when you want to assess the effectiveness of macroprudential policy tools. And that is that tools are being tightened when credit is growing strongly. In an empirical analysis, this can obscure the measurement of the causal effect of a tightening of tools, which should be to dampen credit growth. So what does our paper do? We ask the following 5 questions. First, can macroprudential tools counter a procyclical buildup of vulnerabilities, such as from an excessive growth in credit and asset prices, where asset prices and credit fuels each other procyclically? Second, do the tools increase financial system resilience to adverse shocks? That is, can the use of tools reduce amplification of shocks and maintain stability of credit and output through stress periods? Third, how do the effects vary with the calibration of tools and over time? Fourth, how bad are the side effects of tightening of tools on output and from potential leakages? And finally, how do the tools interact with other policies? Do the effects vary, for instance, depending on what monetary policy does? We provide answers in the paper based on a meta-study of existing research studies, a survey of more recent research on nonlinear and resilience building effects of macroprudential policy, and also novel cross-country panel analysis of interactions using the IMF's macroprudential database, a chart of which I've just shown you. Our first finding is that macroprudential policy tightening has strong effects on credit and asset prices. As noted, estimation needs to take account of endogeneity when policy responds to increases in credit and asset prices. Recent studies do so, for instance, by using microdata or distilling policy surprises that help identify the exogenous variation in the macroprudential policy tool. And those studies find very strong effects on credit growth, especially for borrower-based tools. So overall, the answer to the first question is yes, macroprudential policy succeeds in reducing the buildup of vulnerabilities. The next slide is based on the meta-study of effects, and it documents what I've just said. It shows the average coefficient for the effect of the tool, weighted by the statistical precision of the estimate. Clearly, as you can see from the chart, all tools have statistically negative effects on credit. These effects are stronger for studies using microdata. Those are the yellow bars. When examining these studies, the effects are strongest for borrower-based tools, LTV and DSTI, so that's in the middle, followed by liquidity tools to the right, and broad-based capital tools last. Third, while many studies focus on the near-term effect on credit, a smaller but growing literature finds that macroprudential policy can also increase resilience. That is, reduce the force of macrofinancial shocks as a source of adverse macroprudential feedback from adverse shocks. New evidence from the pandemic supports the notion that capital buffers can help maintain credit through stress periods, especially when the buffer is explicitly releasable. There is very good evidence for the euro area in particular, and I cite here the study by Couaillet and others of ECB colleagues. And that study is confirming much earlier evidence that was done in the context of the Spanish experience with dynamic provisioning in the context of the GFC. Also, borrower-based tools can increase borrower resilience. For instance, studies show that a debt service to income ratio cap reduces borrowers' propensity to default in the event of shocks. More macro evidence is emerging that can be based on the concept of growth at risk. And that shows that macroprudential tools can reduce tail risks to output growth. And there is a study here by Brandao, Marquez, and others. And in related research for emerging markets, tighter regulation is found to reduce the sensitivity of GDP to the VIX and capital flow shocks. And there's a study here by Bergant and others. A third set of findings is that the resilience effect is likely non-linear, but it does hold up through time. So a general finding is that the marginal resilience benefit of using tools is very large initially, and that the marginal benefit then diminishes when the tool is already calibrated tightly. So for instance, capital buffers can support lending when their release generates additional headroom over and above minimum requirements, so that banks feel capital rich and more confident to lend even in the face of credit losses. For this buffer release to work as intended, a positive rather than a zero buffer is needed, obviously, right? Lifting the buffer from zero can then have large benefits. Similarly, the tightening of borrower-based tools, such as DSTI caps, has large benefits in reducing borrowers' propensity to default as you bring in the cap initially and tighten from high levels down, even as there are then diminishing marginal returns for resilience when calibration becomes tight and the benefit of the tool starts being exhausted. It's also true that these resilience building effects appear to hold up and strengthen over time. And that's true especially for borrower-based tools. And I want to show you that in the next chart. So this shows the changes to a loss function when an easing of financial conditions is met with a macroprudential policy response compared to a scenario without policy action. And that's based on the paper that I mentioned by Brandao and others. So as you can see, taking macroprudential policy action results in a sizable reduction of the loss function at the onset as the lines are going down, right? The reduction in the loss function then strengthens through time, reaching a maximum some 2 years after the policy action was taken. And for borrower-based tools in particular, and interestingly, the effects then persist even longer through time. We interpret this as showing how the resilience benefit of the tools builds gradually in the stock of loans and then persists over time. Let me finally turn to the fifth set of findings on side effects and interactions. The evidence here is that the side effects on consumption and output is generally small, and that's true even for the borrower-based tools, where stronger effects may have been expected. Leakage effects, though, that is the propensity of the provision of credit to shift out from underneath the macroprudential tools that are being employed, are often found to be significant. This points to the benefits of expanding the perimeter of macroprudential actions. On interaction, our analysis suggests that the effects on credit of using macroprudential policy do not depend much on other policy settings. However, for emerging market economies, we find that the effects on credit of tighter monetary policy is reinforced by FX reserve accumulation, so FX intervention, and the tightening of reserves requirements, so a macroprudential tool, in line with emerging market economies, that it's worth thinking about the effects of combining such tools, monetary, FX intervention, macroprudential, perhaps capital flow management measures as well. So let me conclude by drawing out the implications for policy. Overall, we find strong benefits from deploying macroprudential tools, both in terms of them reducing exposure to risk and in terms of creating additional resilience to stresses. In light of these benefits, it's likely, we think, that macroprudential policy remains underused. So countries do not exploit the full benefits that could be had from deploying the macroprudential policy tools. In particular, few countries are building up macroprudential capital buffers, and more countries should consider this, both advanced and emerging, including potentially through building up positive neutral countercyclical capital buffers that are positive even if credit isn't growing excessively, and that then generates policy space for a relaxation. Borrower-based tools are not used everywhere either, and the toolkit is often incomplete. In particular, it's often still lacking income-based tools, such as the debt service to income ratio caps that I mentioned, or the loan to income constraints that can be put on. So overall, these tools are still not used everywhere, and more countries should consider using these tools actively. Of course, further research then is very useful to help policymakers decide how to calibrate the tools, right? It's very useful to know better how to calibrate the tool, given that, as I said, there are likely to be large but decreasing marginal benefits from tightening any given single tool. And this would require data and also analysis on the size of the policy changes, and to have an analysis of this. It can be useful also, of course, to analyze the benefits of combining different tools. Finally, an expansion of macroprudential policy to non-banks is important and should be on the agenda based on the evidence we have in the paper, and also, of course, when looking further ahead. So the emergence of fintech is just one example. So thank you very much. I'll stop here and hand back to Volker.
Okay, great. Thank you, Erlend. I think that was very clear. So according to this IMF research, meta study, not mega, meta study, macroprudential policy works, but it's underused. You have to build up the capital buffer so that you can relax it in crisis. Maybe we get some data for that right now. And too little use of, for example, debt to income or other borrower-based restrictions. So instead of, I mean, for the audience, please, we will do it like this. Remember, you have on the Zoom on the line below, you know, that you have the option Q&A or F&A, depending on what language your software has. That's where you presumably can enter questions, and you can already now start, if you want, you can already start entering questions. We will collect them, and now we will first have a response or a discussion from Elena Carletti, then from Francesco Mazzaferro. And but in the meantime, we can collect your questions, and then I'll be reading the questions and we get reactions. But first, so this just as an info in between. So next, Elena, please go ahead and share with us your views on the paper, on more generally on the issue, also on how relevant it is now. Let us hear your thinking. If you want to share slides, please go ahead.
Yes, exactly. So let me share. Do you see them?
Yes, very good.
Okay, I need to make them big. Okay, so thank you. First of all, thank you very much for having me today. I know how difficult it has been to find a suitable date for all the three of us. So thanks a lot for accommodating all the needs and difficulties. And very nice and very happy to be back in Frankfurt, at least only virtually. I was also 8 years with Francesco in the Advisory Scientific Committee of the European Systemic Risk Board, where, of course, these topics have been discussed again and again. So I'm happy, although I'm not a member of the committee anymore, I'm happy to go back to think about this question. So what I want to do is just really give some very brief comments and just a couple of questions. And in a way, why I agree with Erlend's conclusion that macroprudential policy is important and should be used, and it has been a huge improvement in a way after the global financial crisis. I'm a little bit, let's say, less one-sided, if I may say it this way, on some of the conclusion that he had, in particular some of the benefit. I would be maybe a little bit more careful, or trying to smooth them a little bit, or at least to have some reflection. So as I was saying, I mean, in academia, we know since many years that systemic risk is important, but somehow financial regulation has lagged a little bit behind in terms of thinking about the systemic risk meant, as Erlend very clearly said, both in terms of building up vulnerabilities and resilience once shock occurs. So undoubtedly, there is no discussion that the goal of minimizing systemic risk, in addition to idiosyncratic risk, as we were used to think until macroprudential policy was introduced, is positive and should be there, and the focus should remain high. However, I think Erlend hinted a little bit to this, but I really think that one of the main problems in macroprudential regulation is the evaluation of its effectiveness. Because either we have these big country studies where there are a lot of problems, not only of data, but of course, or endogeneity, or we have sometimes very micro data analysis of specific cases that pose question on how general the results are. And we have this sort of bang, either these big macro studies or this more micro data study. And therefore, we need to be careful with the conclusion that we derive from them. And I will be more precise when I will show you exactly the same graph that Erlend presented before with this different result of micro and macro studies. And also we know, of course, that macroprudential policy, I mean, contains some tools, but of course there is interaction with many other tools. In the paper they consider FX tools and others, but I would say also much more simply with capital regulation. Ultimately, from the perspective of the bank, whether this is CYB or whether this is SREP capital, I mean, SREP imposed capital level is not that different. I mean, for the bank is a capital level, and therefore I think it's a little bit difficult to fully disentangle the effect, at least of capital-related macroprudential policy from maybe other policies. And finally, I think if we look at the recent period, we can think about some very interesting consideration. First, in terms of COVID, I mean, Erlend said before that the release of macroprudential buffer should support lending. And I think overall it had this effect during the COVID crisis. But I'm not quite sure how much effectiveness there was in actually bank using precisely the release of the capital buffer, but I will be more precise on that. And lastly, the more recent turmoil in US and in part Credit Suisse, I think they have brought again the attention to liquidity. So one encouragement is to think of macroprudential policy not just as capital as we normally think about or borrow specific measure, but also in terms of liquidity, where I think is actually the field where there is the bigger need, if I may call it this way, on focusing on macroprudential policy. So let me be a little bit more specific now with a number of questions that I have, in particular on the 2 points that Erlend talked about. So macroprudential policy and the build-up of vulnerabilities and emerging evidence of effective resilience. Now, the paper and the slide of Erlend were really saying tightening of macroprudential policy has strong effect on credit and asset prices. Now, I know what it means behind that. Of course, we want to curb excessive credit growth ultimately, but stating that we manage and we are successful in limiting the buildup of vulnerabilities because we have a strong effect on reducing credit raises the question to me whether, first of all, this reduction is sufficient for the containment of the buildup of vulnerabilities, or if not excessive, the reduction in credit. So in a way, shouldn't we have an idea of how much we would like to curb credit with a particular tool before we can effectively say it has been effective in containing the buildup of vulnerabilities? And then, as I was hinting before, there are, of course, indigeneity issues. And if I look at this slide that you showed, I wonder, and I would like to ask the question to Erlend, how do I think about these results? And I don't know, for some reason in copying your slide, the colors change, but it's always the same graph where you have the red bar that I understand is the result of the analysis using microdata and the green and macro data. And we see that the difference between the green bar and the red bar is quite significant. So then I wonder, what do I take from that picture in terms of what is the real effectiveness in decreasing credit of the tools? Do I have to believe more in the result of the microdata or the one of the macrodata? The microdata will be more indigeneity free maybe, but the macrodata may be more applicable. So I was just wondering why, whereas in this broad base, there is not such a striking difference depending on the database one uses. Here, there is a really striking difference. I was wondering where this may be coming from, any particular, what implication may have for the design of the policies themselves. And then, I mean, this is, of course, is a cheap comment. We know in terms of resilience that the capital buffer support the credit through stress period. And I think this is indisputable. If a bank has a higher capital level, the bank can support lending more always in normal times and in particular in stress time. I think this is indisputable, and there is a lot of evidence on that. But of course, I mean, the paper argues that the transition effect, we know that there may be some excessive credit lending reduction in the transition period when you are asking a system or a particular bank to raise capital level. And I thought maybe that the conclusion of the paper may have been a little bit too strong in saying that it's always weak, the effect. I think this should be thought carefully. I mean, in micro financial regulation, we do have a paper where also show that once banks were asked to recapitalize, at least in the short period, there were some real effect on corporates because banks were cutting lending excessively, and therefore corporates were not able to substitute with other form of lending. Well, and the last question maybe is really how to disentangle the role of macroprudential tools relative to other tools. As I said before, from the perspective of the bank, is the total level of capital that matters. So how can we be really sure that this is the CCYB and not maybe the impact of the SSM in the case of Europe asking a higher capital requirement to banks? I think this is probably difficult in reality to disentangle. And I'm fully supportive of the leakage effect that the paper talks about, therefore, of the need of expanding the perimeter, that we can't keep regulating only or mostly the banking sector and leaving other parts of the financial sector more unregulated. I'm fully on board on expanding this perimeter and try to make it as broad as possible, because clearly otherwise you will also always have the potential of a leakage effect. The last comment may be on the reflection from the recent period. I think the COVID-19 pandemic was an excellent example of a purely exogenous shock that had the biggest benefit, if we can find a positive effect in the COVID, of really creating a very solidarity, but both among regulators, but also for what concerns Europe, also from the perspective of fiscal policy. And if I think of the way in which monetary policy, fiscal policy, financial regulation and supervision have really been coordinating all over the world, basically, but mostly in the Western countries, it has been really important and one of the main reasons, in my view, why overall, despite all the problems of the COVID-19 pandemic, the societies and the economy was able to resist to what was happening from a real economy side. Now, in a way, the only question I have, and I remember we were discussing also when I was still part of the advisory scientific committee with Francesco, macroprudential policies have been released in that period. LCR, if we want to categorize it as a macroprudential tool, has been released, CCYB, other measures. But we were discussing at the time, and I don't know the final data, but I wonder to which extent really banks made use of the release of this buffer during that period. And if it is the case that there hasn't been a very big use of the relaxation of these buffers, in particular, I don't think any bank has gone below 100% of LCR, to my best of my knowledge at least. I think we should ask the question why, because macroprudential policy cannot be effective only in tightening. It's very important that it's effective also in release time. And I, maybe because I do this experience in the private sector, I think private banks, and rightly so, are very cautious and very attentive to what regulators and supervisors tell them. But of course, they're also very attentive to market pressures. And for a bank, going out there and say and show to the market that it has reduced LCR below 100, maybe idiosyncratically, so not the whole system, but as an individual bank, or say that it has reduced capital and one day will be asked to raise again, is not an easy move, and it will be attract attention on the market, doubts of the investors, and so on. So I wonder whether there is a way in which we can improve the effectiveness of the release of macroprudential policy, assuming that what I'm saying, that there hasn't been maybe a wished use of the release is true. And finally, the US banking crisis, and also to some extent the Credit Suisse, has really shown the importance of liquidity regulation. I know some economists think that overall, ultimately, Silicon Valley Bank and First Signature Bank and so on, they were also about a matter of capital. I am convinced that this crisis pointed the attention to liquidity that has been somehow silent for decades, because we know monetary policy and rates, and rates were negative, and there was a very important, an abundant amount of liquidity on the market. But I think we really need to rethink about liquidity regulation, starting with things like, how do banks do their asset liability management? What do they do in terms of derivatives? What is their investment portfolio? These famous unrealized losses, what is their hedging, and so on and so forth. And if we think about the monetary policy, of course, it has an impact on the behavior of banks, and therefore we should think more about the interaction between monetary policy and financial regulation, for sure. And let me stop.
Well, thank you, Elena. So a whole range of questions also for Erlend to respond. But first, let's have a look at this also from Francesco Mazzaferro from the European Systemic Risk Board.
Thank you very much. I wanted to check, first of all, whether you can hear me. And
yes.
Well, very good. So let me, first of all, starting by commending the IMF for the work which they are doing. So I think it's not only limited to this excellent paper. Last week, we had some of the authors presenting to a conference we have been co-organizing with the Central Bank of Finland about the differential effects of macroprudential policy. There is also an excellent paper I just read about calibrating macroprudential policies in Europe, in particular on a borrower-based measures. So it's absolutely clear that the IMF is doing a systematic effort of thinking about macroprudential policy, which is much welcome. Now, the things I would like to say, and I will speak really in personal terms, are basically four. First, I would like to comment on what are the specificities of the European case. Now, when I speak about Europe, speak the European Union. And in some respect, also the Euro area. So I would like to tell the story of why some of the results for Europe could be also a consequence of the institutional and policy framework in Europe. Second, I would like to interrogate myself of how we can use of macroprudential policy in a time of endemic uncertainty, a bit like we are. Third, I would like to speak about whether, discuss on whether some extraordinary measures which have been taken by non-macroprudential institutions, whether they are macroprudential in nature. And the fourth, I would like to finish with some reference to what is happening in terms of macroprudential policy for non-banks, because there are developments which are occurring in Europe. So let me start with the first point. When we are speaking about macroprudential policy in the European Union, we have to, first of all, focus on the fact that it is a policy which is developed and can be used only under some constraints. One constraint is the single market. The second is, of course, the monetary policy, which is unique to a number of countries. Now, single market. Macroprudential policy for banks, now I'm speaking for banks in particular, can be exercised only as an exception to the maximum harmonized definitions of the single market. There is an article which is well known to all those which are doing macroprudential policy in Europe, which is the Article 458 of the Capital Requirement Regulation, which basically says that indeed macroprudential policy can be exercised. It can be extended to important things like the level of own funds, the requirements for large exposures, public disclosure, so the full of Pillar 3, the level of capital conservation buffer, liquidity requirements, so also some of what Elena was referring is already foreseen. It's possible to do macroprudential policy on liquidity, the risk weights, interfinancial sector exposures. However, all of this is subject to two limitations. First, it cannot go beyond measures which are valid for a couple of years. After that, everything has to be discussed. And second, there is also a limit in terms of size to what can be made. And the limit, by the way, is subject to examination of a number of institutions. So in reality, the macroprudential policy makers very often cannot take the decisions alone. Why it is so? Because there is the wish of guaranteeing a level playing field to banks and other financial players, so that, so to speak, macroprudential policy is not breaking the single market. The second specific condition is the fact that macroprudential policy in the euro area cannot really have, like is discussed in the excellent paper of the IMF, the role of strengthening monetary policy. Because in reality, the way in which macroprudential policy can be exercised in Europe is mainly to cope with the one-size-fits-all problem. So the monetary policy stance, by definition, cannot fit with all the regions of the euro area. And the first line of defense when this is not possible, when this happens, sorry, is not to modify the monetary policy, but to activate macroprudential policies to reduce the problems. So this to give an idea of what are the specificities of the euro area. Second point, we are more and more confronted with a situation in which the signals which we get from the economy and the financial sector are not simply of a good or bad time, but are very ambiguous. and are creating a number of question marks to which macroprudential policymakers have to answer. And to have a good answer for that is important to avoid a bias to inaction. Now, one possible way of solving this problem could be developing a good mechanism of macroprudential policy stance. This is something on which also the fund has been working. We at the ESRB are working as well. And it's basically an attempt to try to define on whether the degree of action of macroprudential policy is in line with the risks, and whether also the possible damage in terms of GDP losses is or not in line with identifying systemic vulnerabilities. The third point I would like to make is to ask myself on whether macroprudential policy, in the way in which it's been exercised in the last months and years, even the last months, in this situation of very strong uncertainty, has not been exercised in reality, not only by macroprudential authorities, but by others. I would like to give some example. A few months ago, LCH, one of the largest CCP of the world, has been confronted with a squeeze in the nickel price, with possible very large systemic implications. What they have done is something which was unexpected. They have been canceling orders for an entire day. We had recently in the US the decision of authorities to increase deposit guarantee using a systemic clause. We had over summer of last year a number of important governments of Europe. I remember Sweden, Austria, Germany, etc., extending emergency state guarantees to the financial sector because of liquidity squeezes in the energy market, the TTF. And we saw also the Bank of England intervening massively to save the gilt market after the LDI fund episode. So all of these things, which to a certain extent are emergency measures, which are not foreseen in any of our legislation, in reality are probably more macroprudential and are more effective than any use which can ever be made of by the countercyclical capital buffer or any risk buffer in Europe. Finally, I would like to finish this picture of, so to speak, inputs by referring to what is happening in the non-bank financial sector. In these hours, there is an important negotiations which is going at the end in Brussels after years of preparations, and which is basically the finalization of the legislation for alternative investment fund managers and UCITS. And we are very pleased to say that for the first time, there will be an important role for macroprudential policy. We will see rules on loan origination, which of course also will create some more level playing field between banks and non-banks at the moment in which they are lending. And we will see a set of liquidity management tools which may be used by alternative fund managers, and also possibility for authorities to intervene in cases in which the redemptions are not in line with the liquidity of the assets. At the same time, there is the discussion going on whether to include the liquidity tools for insurance in Europe in the framework of Solvency II. So if things go well, when the IMF will redo this analysis in some years, they will be able not only to consider the impact of macroprudential policy on banks, but also of macroprudential policy on financial sector, on the financial sector as a whole. Thank you very much.
Well, thank you, Francesco, for your remarks. So we may have more emergency measures being more effective than anything Macropru can do, at least in terms of crisis alleviation, not in terms of crisis prevention, but also very important differences in Europe. And I think let's talk a little bit more about that. And also about the recent crisis, maybe differences between the US and Europe. Erlend, let me give it back to you for 2-3 minutes to respond to some of the comments from or in questions which Elena and Francesco raised. Let me add also, so what happened in the US? Did they not use it sufficiently? Obviously, we had some major interventions by the government, and we had some somewhat foreseeable developments. I mean, the fact that the regional banking system is having trouble is not surprising, given that interest rates have risen so much so quickly, and this was not totally unlikely from happening. At least people, just throughout the low interest period, also talked about that type of risk. Maybe it's still coming in Europe. Maybe all is safe, and we just have much better buffers. I don't know. So back to you, Erlend, for a few minutes, and then we collect also some questions from the audience. I mean, they have already submitted questions. So to everyone who's listening, feel free to write in more questions. I'll be reading them shortly. And also you can vote on the questions if you want to emphasize your support for some of these questions. Erlend. We need to turn up the sound.
Yeah.
Okay, good.
Is it better now?
Yeah.
Okay, yeah. So Elena raised a number of really good points, and I want to perhaps take a couple of minutes to respond to those. So one thing is about the effects on credit, and then the objectives of policymakers. So what we report in the paper are the effects on credit that you can observe on and expect on average from a use of macroprudential policy tools that we have in the data, right? So that's the that's what's measurable. Maybe 2 points on this. One is that as you asked, why is it that the effects on micro studies is larger? I think the main answer there is in part, of course, that what these studies are doing is they are looking at banks that are more like where the tool is likely to be more binding on the behavior versus banks where it's less binding on the behavior, and trying to distinguish between those two situations, and that in part gives you bigger effects, for those tools that are for those banks, let's say, or those agents where it's more binding. So it's clear that this is sort of showing more the marginal effects, and the macro evidence is showing more the average effects, right? So that's one point, just to clarify that this is the case. The second point I would make, though, is that it's not clear, and we wouldn't necessarily advocate even to reach for the biggest effect on credit, right? So it may not be, from a normative perspective, even desirable to try and stifle credit as much as possible, right? That may not actually be the objective. So from a normative perspective, the question then becomes, how much of an effect on credit do you actually want, and how much are you really going to be satisfied by having the resilience building effects of the macroprudential policy tools sort of build within the banking system, within the borrowers. And I think while the literature has been focused a lot on what are the effects on credit, actually, one of the messages of the paper that we have is that it's worth thinking about these resilience effects. And we're quite happy that more evidence is emerging that also puts a spotlight on those resilience building effects, because we think that these are really first order. We think actually building resilience is the first objective of macroprudential policy tools. And as I said, you may be able to do some of that, building some of that resilience, even as you bring in, even as you calibrate the tools in a manner that isn't all that binding on either the borrowers or the banks, right? You may get resilience benefits as you bring in the tools, and the tools start disciplining behavior in useful ways, even if the calibration isn't overly tight. So that makes us think we want to encourage policymakers to do some of that, right? To reap some of those benefits. So that's the first couple of points. The second point I'd like to make is that I think it's not the case that capital is capital, and it doesn't really matter which capital buffer or constraint you are looking at, because from the perspective of the banks, as long as they are subject to the ladder and the whole range and the composition of all of these capital buffers, yes, they will look at the whole stack, right? They will look at how big is it overall. But then the key design issue here is that some of these capital buffers are releasable, right? So you are going to be able to, in stress periods, to reduce that stack, that overall stack of capital, right? That the banks are feeling that they need to meet, and perhaps they need to meet continuously. So that, I think, is a big distinction between the macroprudential policy buffers that are releasable and sort of microprudential capital requirements, which are really understood to be, that need to be met all the time, and that can, though, because they are meant to be met all the time, actually turn out to be pro-cyclical, right? So if you have a high microprudential minimum requirement and the banks are hitting that, you shouldn't be surprised if you actually see the provision of credit to the economy go down because banks feel like that they become capital constrained. So it's very important, I think, this distinction between releasable and not releasable capital. The sort of a related point I would make on that is that, again, we've had scanned evidence of how well that release is working. And you're right that, the COVID research isn't fully conclusive, perhaps because while we've seen the release and we've seen credit respond to the release, it's not clear that we've had sort of huge losses having built in the banking system as a result of the COVID shock, right? Because there were other measures that kept these losses low: fiscal support, monetary policy support, and so on. So I agree that the evidence there isn't fully conclusive. I also think, though, that if you put it together with some other evidence, including on earlier episodes, I mentioned the Spanish experience, also in the context of the GFC, with provisions that were essentially releasable. And, you start to see an emerging evidence that that release is actually useful, because then also in the Spanish experience, what's found is that banks were more willing to keep lending to corporates and to households that needed the credit when the provisioning requirements were lifting. So there is some evidence that there is a good effect of this, and so yeah. But I also want to fully agree with your point that it's not just capital; it's also liquidity requirements and liquidity buffers, and that is something that perhaps is shifting more into focus now, with also the sort of the recent experience So if deposits are, perhaps more flighty than we thought they were, then thinking about the right design of deposit insurance is one response, but also thinking about whether liquidity requirements and buffers should provide incentives for more self-insurance against liquidity runs on the part of the banking system is an important question to ask. And then thirdly, though, asking whether central banks are in the position to provide liquidity to banks in need as needed in these stress periods is also a third question to ask in that area. And some of that is going beyond just macroprudential policy. And I want to also be on record saying I don't think macroprudential policy is the full answer to all of the questions and issues we are facing.
Okay, anything on US and Europe and Francesco's questions or comments?
I didn't have anything specifically on this. I think maybe Francesco wants to talk about the European experience. I don't really have anything to say on country specific issues at this stage. At
this time, okay. Then let me collect some of these questions which people have written. So first, Jürgen Michels asked specifically on your results, on your empirical results. He asks, how important is the easing of the measures in crisis periods, for example, in COVID, for the overall positive impact of the measures? Did you kind of decompose that, whether possibly that's my comment to it, whether one particular effect is driving the empirical results here, the periods where the measures were eased? Did you understand?
Yes, I think the design of the research that we are reporting is such that you are looking, or the study looks at the release of capital buffers, and I think the idea there is that you are again doing this at a bank by bank level, and the research design would distinguish between banks that benefit a lot from that release, right, which is the same number for everyone, versus banks that perhaps have a lot of capital beyond the requirements and that do not benefit all that much from the release. And that's the way you can sort of tease out this effect that I mentioned, where banks that see their headroom over minimum requirements expand a lot as a result of the release. Those banks are then responding more strongly to the release. I'm not sure whether that answers the question. And in particular, though, also it's true, and I alluded to this, both in these studies more recently for COVID, but also in the study that I mentioned on Spanish data. Ultimately, the research also tries to look at bank-firm relationships and is able to show that it's really the supply of credit to the stricken corporates that is holding up better as you release the tool.
Thank you. Maybe Francesco, I've seen your hand, but let me first read another question here to Elena by Romeo Nell. Fully agree that the US crisis was on liquidity. Can one conclude that it was a result of poor liquidity risk management? And maybe let me add, what would you do? You didn't get so precise, Elena, in terms of liquidity regulation, what you would like to see to prevent these things.
Well, I mean, first of all, these banks, this group of bank of the medium-sized banks, they were not subject anymore since 2018-19 to liquidity regulation. So in a way, I mean, it's not just a matter of changing or reforming the current liquidity regulation, but is rather implementing the liquidity regulation to all type of banks. So in a way, I think this crisis shows the importance of having liquidity regulation, because when you don't have it, you see what may happen. Having said that, I think the crisis show, however, how fast the deterioration of liquidity can be. So if I think, for example, about CR or NSFR, the idea that this exercise is calibrated on 30 days. So the bank has to survive 30 days of liquidity withdrawal. So when we have seen Silicon Valley Bank losing 1/4 of deposit in a day, I think this raises the question whether the time that we are incorporating in this liquidity regulation is still appropriate in a time of digital banking and where people and corporates, as in the case of the US banks, can withdraw so rapidly. So that is probably, so 2 points. One is apply liquidity regulation to everybody. Don't accept banks or group of banks from liquidity regulation. But the second, to rethink whether the criteria incorporated in the current regulation are still appropriate nowadays. And if I may add, I didn't say before, and I want to say that I also want to congratulate Erlend and the team for the paper, because I found this was greatly interesting. So thank you for involving me in this exercise. And if you allow me 30 seconds, what I meant to say from the capital perspective, that banks are the same, I fully agree with you that one is releasable and the other is not. But from the bank perspective, in normal times, all capital requirements form what is called the maximum distributable amount. So they must respect it in the same way. So from this perspective, I mean, from the perspective of the bank in normal times, there is no difference. On the contrary, while they can make it, they can reduce or affect the micro capital requirement, they cannot do anything for the macro. So there is no way they can become more efficient or better bank vis-a-vis the macroprudential regulation. So in that sense, it's even a bigger tax, if we can call it this way, on the bank.
Elena, if I may just follow up, you said liquidity crisis, but you also mentioned Silicon Valley Bank. I mean, Silicon Valley Bank seemed to be insolvent once, given that they had not marked their portfolio on government bonds to market. So what would it have helped if they had more liquidity?
If there had been liquidity regulation, they couldn't have had an investment portfolio as the one they had, because they wouldn't have been able to invest so much, I mean, such a big part of their asset in such a long maturity portfolio, because it would have probably not fulfilled the liquidity regulation. So in that sense, they were out of, I mean, European banks don't have this maturity mismatch as pronounced as the Silicon Valley Bank had because of liquidity regulation. So of course, the liquidity turns into insolvency, but the starting point was liquidity problem, in my view.
So, Francesco, you've had your hand up for a while. Let me have you jump in, and then let me go back to the questions and finish up the questions which are available. So, Francesco.
Yeah, I wanted to comment on the question of the release. So, indeed, the release is the, so to speak, the weakest and will be the most difficult phase of exercise of macroprudential policy. Now, on the questions on whether capital is always the same or whether capital forms are very different, I have perhaps an intermediate view between Erlend and Elena. So my impression is that banks, by and far, do not have great problems to releasing the countercyclical capital buffer, because the countercyclical capital buffer is seen by definition by markets, by credit rating agencies, by competitors as being a countercyclical tool. While for all the rest of capital instruments, banks are to a certain extent terrorized of the idea of going beyond the minima, even if when it is possible to do it from a legal point of view. In my view, this means that we have to make more use, and this is completely in line with what the IMF was saying, of neutral, non-zero countercyclical capital buffers, which basically means that we are clearly signaling to markets and to banks that there are potential, so to speak, margins for countercyclical use of capital, which is independent of the credit to GDP dimension. And in fact, what is happening is that there are more and more member states of the European Union which are doing so. On the question of liquidity, the question of liquidity goes beyond the banking sector. We have seen in the last years problems of liquidity in some of the safe assets of the world. Let's think about the liquidity problems of the treasuries. We have been problems of liquidity which are caused by the mechanism in which CCPs are basically calling for margin calls, and in many other segments. So it's important to have a systemic approach to it, to have idea of systemic liquidity. And of course, at the very end, we have to look at the interaction with monetary policy. Thank you.
Thank you, Francesco. So let's take the last three questions. I'll mention them quickly in a row, and then let's have a set of responses if you want, maybe starting with Erlend, Elena, and Francesco if you want. So first, the questions. One question is about fiscal policy. So what implications for fiscal policy do you find, or do you see to support the effectiveness of macroprudential policy? So what implications for fiscal policy to support the effectiveness of macropru can be derived from the studies? So I guess it's primarily to Erlend, but also to others if you have something to put in. Second question, what about the risk of overregulation? How is that being addressed in practice? Given that, you know, macroprudential tools are useful but impose restrictions on business. So what is that something we slightly touched on but not as strongly? And then finally a question on how could the IMF help countries interested in implementing them? If you said macro policies work and more countries should put them in place, do you have IMF technical missions? I don't know. Okay, so let me, for these three questions, starting with Erlend and then Elena and Francesco if you want to. But let's keep the answers also short. We have 5 more minutes. We want to finish. We can go a minute or two over, but let's not stretch it too far unless we get some additional questions. Erlend.
I didn't quite get the second question. Could you repeat that?
The second question was about the risk of overregulation. How is that addressed in practice, right? Because macropru may restrict business.
Right. Okay. Let's see. On fiscal policy, yeah, I think we, as I said, and I think I alluded to this at the IMF, we are thinking about a sort of an integrated approach to using several policy levers, right? Monetary policy, fiscal, macroprudential policy, and so on. And I think that can be beneficial when it comes to thinking about the current conjuncture and stresses that can emerge perhaps in the future. So in the current conjuncture, we are seeing a lot of monetary policy tightening, at the margin. Of course, that tightening will put pressure on borrowers and perhaps on the financial system. We think that if fiscal policy did more of its part to also help reduce demand, lower inflation pressures, that can be useful, because monetary policy tightening and then at the margin doesn't need to be quite as sharp. And that has financial stability implications, where then the risks to the financial system, the ability of borrowers to keep up debt service on existing debt and so on, is going to be reduced. So in a way, it's useful. I would agree that it's to think about the contribution of fiscal policy also in that overall policy mix. And as we've seen in the COVID experience, it's true that fiscal support to borrowers can help in periods of stress, when monetary policy is starting to become accommodative. Fiscal support can also help, and as we've said, that can also help the overall effectiveness of the macroprudential policy response, because losses then will be less than they would have been otherwise. So I think it works both in the run-up and in crisis times, that fiscal policy should be part of the policy mix. The second point about risk of over-regulation, that is very important, of course. We do not want macroprudential policy, regulatory policies to stifle credit, make it hard for businesses to to get the finance that they need, and that is in a way shaping our sort of thinking, or should be shaping the thinking on the calibration of macroprudential policy tools. And that goes back a little bit to the discussion we've had earlier, right? Where it may not be useful to tighten the tools too much, because that can have potentially detrimental effects. So policymakers need to be mindful of that and cautious in their approach to tightening macroprudential policy tools. As I said, the calibration is really important. Getting the right dose of macroprudential policy is an important issue, and also getting the timing right is an important issue, right? So you can do more macroprudential policy tightening when credit overall is flowing abundantly. You're less concerned that you're rationing out businesses than if perhaps credit overall is more fragile. Thirdly, the IMF is providing advice on macroprudential policy tools in essentially all of our sort of bilateral advice. As you may know, we have annual surveillance consultations with all of our members, and macroprudential policy is one of the policies that we discuss with our members every year, basically, alongside monetary and fiscal and other financial regulatory policies as well. We have an FSAP program, the Financial Sector Assessment Program, that we run out of my department, the Monetary and Capital Markets Department, where, again, the idea is to do a sort of a deep dive of the financial system, and to, in the light of that, think really hard about what are the potential policy measures that the authorities may still be missing, and that could be deployed to reduce, to control risks more effectively, perhaps, than the authorities are already doing. So that's an area where macroprudential policy is very much part of the overall package of discussion. And we finally have a TA program as well, where we are doing TA on, more on the calibration of perhaps of specific tools, given the data situation and so on. So, and we want to do more of that, actually, of this technical assistance as well. So I'm grateful for that question.
Okay, Brief responses, if you wish, also from Elena and Francesco.
No, I can just say that I think the second question on the risk of overregulation is very crucial, and it's very difficult to do it in practice, a very sound analysis and understand exactly, and there will be mistakes of type 1 or type 2, meaning too lax regulation or too strict regulation, but that is a little bit inevitable with any regulatory tool in my view. Maybe with macroprudential it's a bit more difficult to disentangle just that tool, but it's the risk of regulation in general.
And Francesco?
Well, on this latter point, macroprudential policy exists because of externalities. So one should also know that very often those which are concluding contracts in the financial sector do it under the implicit expectation that the costs of macroprudential nature will be covered by others. So from this point of view, the risk of over-regulation should also be weighted with the risk of under-regulation. On the question of fiscal policy, obviously fiscal policy is part of the story in all directions. So the decision of the US authorities to extend the blanket guarantee on deposits has, of course, implications for fiscal policy. Like the decision of all EU governments to basically save all the borrowers of Europe, in particular the industrial ones at the time of COVID, of course, has been reducing the importance of macroprudential policy, because fiscal policy is much more powerful than any capital buffer can be. Thank you.
Thank you. So that brings us to the end. Maybe let me also add from my side, thanks to everyone, thanks to the IMF. Let me also add, I think and I think Francesco made that point already. I mean, in a situation where financial sector organizations, banks can profit in good times, but at least be supported, or for example, depositors who are uninsured being bailed out in bad times, there is a very strong case to raise the safety barriers so that is not ultimately borne by the taxpayer. So on that note, let me conclude. Thank you to everyone. Thank you to the participants. Hope to see you next time at the next event. So stay tuned. We'll keep you updated.